The question review now is the Degnis part A. So here we move to the questions. Read it first, and then coming back to listen my presentations and also the illustration of this past paper question. Okay, for part A, the requirement is, okay, first of all, I would like to share with you for myself, I would like to read the requirement first before going into the details of the questions. So for me, part A, what is the requirement? It is, the requirement is calculate the expected net present value for the first 4 years. Okay, in other words, the project may be lasting for more than 4 years, but we only focus on the first 4 years of operation. So here is a company which is planning to invest 4 million. So initial investment should be 4 million. And the demand is showing here. In each year, the demand is showing here. For example, for the first year is 250, second year is 300, and then 450 and 450 in the third and fourth year. And how about the revenue and the cost? So here we can see the selling price. We can see the conversion cost here. But the most important part is given a probability of selection. In other words, this question is asking us to calculate the expected value. Okay, because a probability is assigned to each of the options, like basic, standard, and deluxe. And also there is a fixed cost here. Given that the corporation tax rate is 28%, okay, so there's a tax considered. Also, there's a tax allowable depreciation, TAD, on the cost of investment on the strict line basis over 10 years. Okay, and the discount factor using is 11%. After tax discount rate is 11%. So we are given all the information. We have the tax. We have also the depreciation. So we should have the tax saving. Also the tax saving, tax on profit, and also the tax saving, and also we have the revenue cost and fixed cost. So we don't have the information about inflation, so we no need to take care about the inflation in these questions. So as my practice on doing all NPV questions, first of all, is I would like to put the template for any of template. So we double check the tax. The tax liability being settled in the year in which it arises. So it means that once the tax liability comes out, it has to be paid by the company. So there's no delay. Okay, the tax cash outflow is no delay in this situation. So bear in mind these assumptions put in the questions. So is it any 5 years? No. Okay, because we have no tax deferred expenses or deferred payments. So we have the revenue, we have the conversion cost, we have the fixed cost, we have the initial investment, Okay, so we have the cash flow. And then we have the tax liability. We have the tax saving from the depreciation, right? And then comes to the NCF, net cash flow, with discount factor. So we have the DCF. And first of all, we need to work out the revenue. The first working is we need to work out the revenue. But before working on the revenue, I would like to say here is a bit tricky because the revenue is coming from, how to coming from? It's coming from the selling price, right? And the selling price, we have not only one selling price, we have three different selling price with three different options. And in each option, there's a probability assigned to 20%, 45%, and 35%. So here, first of all, in the first working, we have to calculate the expected value on selling price and conversion cost. Okay, because these two costs are variable factors based on different volume and different prices in each different scenario. So we have to calculate it first. For the selling price, okay, we have 20% probability at setting at the basic. So here is should be 30,000 and 45% with 42,000, which is the standard, and then the deluxe, the percentage is 35% times, for the deluxe price is 72,000. So what we call the expected selling price here is 50,100 per unit is the selling price. And for the cost or conversion cost, we apply the same logic. 20% on the basic, which is 33,000 plus the standard option, which is 45% times the cost is
29,000 plus.
So we finish for the first working to get the expected value on both selling price and the conversion cost. So we move on to work on the second working, which is to get the revenue as well as the conversion cost and also the fixed cost. So working the second working, we have to work on the revenue. Okay, in each year we got the number of units. And we got the price for each year, which is at 50,100. So the revenue for each year we get for the first year should be 12 million 525,000. For the second year, which is 15 million and 30,000. For the third year, which is 22 million 545,000. And the last year is the same, 22 million 545,000 is the revenue. And for the workings, maybe I put it is the third working is the cost or the conversion cost. The conversion cost for each unit, which is 31,650. So for the first year should be 7,912,500. Second year, 9,495,000. For the third year, which is 14,242,500. The fourth year is the same as the third year. All right. So we can work on next. It's about the fixed cost. So let's check the assumption. For the fixed cost, okay, it's based on the units in each year. So for the first year, which is should be 4 million, because it's between 200 and 299. For the second year, which is 300, should be 5 million. For the third year and fourth year should be 5.5 million. Okay, it's given based on the questions. Okay, and also we have to work on the depreciation. So for the depreciation, I say here's the third working or fourth working, because if we just work on the fixed cost should be the third working. Okay, here should be the fourth working. Okay, anyway, here should be the depreciation. For depreciation, okay, it is 4 million. Initial investment, straight line for 10 years. So in each year it is 400,000 depreciation charge. And for each year, okay, tax rate is 28%. In other words, 400,000 depreciation charges can help to save how much tax? It's 400,000 times 28%, which is 112,000 per year. Okay, is the tax saving. Okay, because it can be last for 10 years, and we only the requirement is we need to only to work on the first 4 years of operation. So there should be no balancing charge or no balancing allowance, because the end of when it is the end of the first years, the asset is still there, and there's no sign for us to sell it or to scrap it. So we have all this information so that we can put in to this template. For the first year, okay, we got the revenue, and for the second year, we got 15 million and 30,000. For the third year, which is 22 million 545,000. In the fourth year is the same of the third year. For the conversion cost, Okay, for the first year, for the second year. Okay, second year is 9,495,000. For the third year, which is 14,242,500. And for the fourth year, it's the same as the third year. Okay, so for the fixed cost we just mentioned, it's only varied with the units produced. So for the first year is between 200 and 299, so it's 4 million. For the second year, which is 5 million. For the third and the fourth year, it is 5,500,000. Okay, and the initial investment is 4 million. Okay, so we can get the cash flow before the tax or the operating cash flow. Okay, let me revise the term. The operating cash flow. For the operating cash flow, I include the initial investments. Okay, for the first year it is 612,500. For the second year, which is 535,000. For the third year, which is 2 million. Sorry, it should be positive, not negative. My apology. For the third year, which is 2,802,500. The last year, fourth year, it's the same as the third year. Okay, here is the operating cash flow. The tax liability. The tax liability is 28%, which is the tax liability arise in the year when the profit is generated or then the tax liability generated. So in the first year, it is $171,500. Based on the operating cash flow, we put it into consideration. And for the second year, with lower profit, is 149. $1,800. For the third year, which is 784,000. Okay, and for the fourth year is the same. And for the tax saving, because we have the depreciation charge that can be saved. For the first year, and it is the same across all the year, because it is straight line depreciation. Okay, which is included in the here. And the net cash flow, we got 4 million in the first year negative cash flow. Okay, in the first year we just from the operating cash flows minus the tax liability and add back the tax saving, which is 500. And 53,000. And for the second year, is 497,200. For the third year is 2,129,800. For the fourth year is the same as the third year. Okay, with discount factor at 11%. So you just check with your table. So you got all the discount factor from the first to the fourth year, and discount cash flow for each scenario. Okay, you got 498,253, and for the second year is 403,726. For the third year it is 1,516,884. For the fourth year it is 1,403,538. So when you sum all the discount cash flow, you get the NPV here is minus 137,599. So here is the answer. The NPV is negative in the first 4 years of operation. So let me explain after the calculation here. First of all, okay, we need to work out the expected value on the selling price. Usually we have to work the revenue and variable cost first, but because we don't know the unit selling price with different scenarios, so we have to work out the expected value first for both selling price and conversion cost here. When we get it done, then we can go into the revenue calculation and also the conversion cost calculation. And also the fixed cost calculation, because this question is quite easy, just to determine what's the level of the fixed cost. And next we move on the depreciation tax saving calculation. Okay, because we know the straight line depreciation is applied. And for the 4 million divided by 10, 400,000 per year is the depreciation charge, and then tax saving just times 28% with this 400 million, we got 112,000 for the depreciation, for the tax saving arising from the depreciation. When we got all this working done, we can fill it in the template that we initially draft. So we put revenue, we put cost, we put investment, and also we put the tax liability, we put tax saving. So just to remind you, because in these questions the tax liability arises and the tax payment is due when the tax liability arises. So here's the same year when the tax liability arises. Sometimes it is delayed for 1 year. So bear in mind to read the question carefully on this tax liability. Next is tax saving. Tax saving should be coming the same year of the tax liability. Okay, so we can work in the net cash flow after all this. And then we have the discount factor and also the DCF. And finally, we got the NPV by summing all the DCF of each year. Okay. So, finish for this part A.